Yeah, good morning, and I look forward to this session.
Tell me about growth, because that stood at nearly 35%. Which segments have reported that kind of strong growth, and more importantly, is over a 30% growth sustainable for the next 1 to 2 years?
So, first of all, I think this has been a journey of several years. We've been building this institution on several legs. Yeah, and I think from that point of view, as we grow in size and scale, I think our overall competitive position hopefully will keep improving. We had post our IPO last year given out a sort of a long-term indication in terms of our growth trajectory and how in terms of the various operating parameters you should expect us to improve over time when it comes to the various operating and financial parameters of any well-managed institution. So I think what we are tracking to is basically that kind of goal and expectation, and at the same time very high quality execution across the different aspects of our business. The good feature in this quarter was that frankly speaking, there was no negative. I mean, all our business segments, whether it was the corporate segment, the mid-market, SME segment, our retail assets, segments, and our micro banking business, all of it, grew well and grew profitably. So that was the first aspect that we were able to.
So it's a great quarter from every perspective. There's no taking away from that. But loan growth of nearly 35% when the sector is grappling with, a decade low, so to speak, on credit demand and credit offtake. Which segments have contributed, and is 30% plus a sustainable run rate over the course of the next 1 or 2 years?
Well, closer to 30% is what we are pitching for. I mean, at the end of the day, I think it's a high pressure commitment to make. But in a sense, coming from behind, I think we need to earn our spurs. And actually, if you track our compounded annual growth rate over the last 6 years, it is upwards of 40%. But as our base of balance sheet is becoming larger and larger, in other words, the denominator as it grows bigger and bigger, obviously that growth percentage will pare down. But at this moment, I don't know how the future will pan out, but we are pitching to the 30% around that level growth number, even in the future.
And so how is, let's talk about the stress angle, the SME and the microfinance business, particularly from a perception standpoint, are high stress zones. How is stress shaping up in these two segments? You've been able to defend your asset quality well, but just wanted to get a sense of how do you see, growth versus stress for these two pockets?
Yeah, so the microfinance pressure started a few months ago, as we all know, and the entire industry pack has been suffering through that. The good thing in that is that, again, barring 1 or 2 states, in the rest of the country, that business has quite kind of normalized to a fairly large extent. And actually, if I may tell you that even our own disbursements in that micro loan space, starting 1st January this year, have been around 1,750 crores. The 30-day plus DPD position or the delinquency position in that new lending is less than 0.35%, which suggests that this business is, once again back to normal. It has gone back to the pre-demonetization sort of era, and again is a strong high quality growth segment to be in. Excuse me. So in other words, that's the trend. Now on the previous portfolio that we all carried, we continue to make some provisions. Some pockets of that are coming back, and there again you need to be a bit tactical. I mean, there are in a JLG structure where some members who want to continue to borrow and are willing to repay, whereas some others are not. Tactically we sort of separate them out and start making them individual borrowers and, revive that lending cycle. So that way you can bring some of them back into the fold also and even do some recoveries of the past loans. So there are ways and ways. All I can tell you is that again there is a whole range available. The average delinquency in the country may be X. I think we operate at less than 0.3%, less than 0.3x. In other words, we are at the better end of the pack. There are one or two other players who are able to operate, like that. And I think they also do a pretty good job. So I think the whole idea, again, as I said, is how you execute on strategies.
Right. Mr. Ahuja, as per media reports, you were one of the leading contenders for Bharat Financial. Now that the deal is done with IndusInd, would you be scouting for some inorganic growth opportunities?
See, I've said this in your channel and on other channels that we were never a contender for Bharat Financials. Whatever Bharat Financial Services. Yeah, so that was just the news that was going around. And we never even seriously looked at it or ever took that proposition to the board. Yeah, so therefore I completely sort of not subscribe to that rumor, personally speaking. Having said that, we have raised capital a couple of months back. We raised a large chunk of capital through a preferential placement. And at that time, and we are growing at a fairly fast clip. As you know, 30% plus means that I consume almost 55 to 60 basis points of capital every quarter, which is about, almost just under 2.5 percentage points of capital every year. So even my organic growth requirements from a capital point of view are significant. Having said that, so we have enough to do, in terms of our own organic growth and growth momentum. But if we cite a good opportunity, and it doesn't have to be in this space, it could be in several of our various growth.
Right. Mr. Ahuja, so, have to ask you this. How do you see the recent recapitalization of PSU banks impact competition for mid-private banks like yours?
Look, there is no doubt that this move is positive for the banking system as a whole. And this whole problem of the bad loan sitting on the PSU bank balance sheets and their ability to survive and grow was at stake. So that problem had to be solved. From that point of view, this is the big decisive move that was expected to be taken. Now it has been taken, and there is no doubt that it will help in a big way to address that challenge and problem. Now what happens is that certainly as some of these banks become viable and profitable again, they obviously come back into the market, and they will pose some competition. The question here is that at the end of the day, I think when they were in a difficult situation, market share was being taken away from them. I think the benefits of that were going mainly to the bigger players, much lesser to the smaller players. Conversely, if the competitive pressure is coming back, I think it's the bigger players that may be challenged more than the smaller players. I mean, at the end of the day, I think our journey is across several different planks of business. It is going well. It was going well even 6 years ago when the economy was not so good. It was going well 3 years ago when the economy was becoming better, and so on and so forth. So I think we are on our own track and on our own journey with our own momentum. I don't think we will be affected.
Okay, Mr. Ahuja, leave it at that. Thanks so much for taking the time out and speaking with us about how your numbers have panned out and where you see the future profitability
for this interaction. Thank you. I appreciate it.
For RBL Bank. Okay.